Dalal Street ends higher in the first week of October. The Nifty and the Sensex gained nearly 1%. The broader markets outperform and sectoral indices clock gains, particularly the banking stocks. Well, over the next 30 minutes, we'll decode the week's market action. We'll put the spotlight on the RBI's growth supportive measures, and we'll tell you what to expect from the IT companies as they get set to report numbers from next week. Hello and welcome to Editors Roundtable. I am Rima, with me are Prashant and Nigel, and joining us here in the studio is Anish Tavakle, co-CIO Equity at ICICI Prudential AMC. Hi, guys.
Hi. I mean, a better end to the week, right? Rather than how we started off the week. So, two apiece for the Bulls as well as the Bears. And I tell you what, the Bulls getting into this weekend will be feeling a lot better.
Last 2 days, basically, is what matters,
days
right?
At least, yeah.
But then those last 2 days broke that very long stretch of a losing streak, right? 8 continuous days of selling.
And what did it was perhaps maybe, I mean, we can give credit. I think the RBI. But it is no rate cut. Although many said it was a close call, it looked like a close call. But many things, and we'll talk about that as we go on, which kind of, the stance actually is what is very, very clear, that they are very focused on trying to revive growth one way or the other. And Manish, welcome to the program. You're coming on after a while. Yeah. What did you make of it? I mean, we'll go into individual steps, but what did you make of it?
See, I think you should have to look at the RBI's actions over a 3 to 4 month period. What have they done over this period, right? And so even in the previous meeting, they had acted quite boldly and given a 50 basis points rate cut, which is actually a lot, right? And it takes time to work through. So they've made it clear that they do want to revive the economy. They do want to revive demand. This time's move, while they haven't cut further, which is, I think, the right thing, they have made clear that they stand ready to do more if the economy does require it. The steps they've taken actually frees up the banking sector to do more. It is supportive of growth, but it also helps banks relative to NBFCs, right? So in terms of the competitive position of banks versus NBFCs, it improves the competitive position of banks.
On this rate cut, we had a chat with Tata Cap, right, when the IPO, on the IPO press conference day, and I asked him about transmission. So at least at the NBFC level, I said 100 basis points of rate cut by the RBI so far, and I said, how much have you passed on? And he said, I think about 25, 30 basis points. So, I mean, there is some transmission left to be done of the rate cuts which have already been announced so far.
Well, that's right. In the startup cap, normally when you have a big IPO like this, it gives some of the competition as well some kind of legs. Case in point being in AB Capital, Aditya Birla Capital. Today, in fact, the stock hit a fresh 52-week high, because there's suddenly that argument about valuations and ratios being more or less at par. So let's see how that goes. But before we move on, let's just, do a quick recap of what we saw in this week itself. The Nifty, the fear was that we won't be able to defend that 24,500 odd mark. We went ahead and we defended that mark. We broke that losing streak. We had 8 straight sessions on the trot when the Nifty ended lower. That broke, and actually October has started off on a positive note. And if you look at historical data, the last, out of the last 10 Octobers, 70% of that we've seen positive returns. So you want to clutch onto straws, right? When you're seeing the markets see 8 straight sessions down. The other important factor is the FIs. They've not just been selling in the cash market. In the F&O market as well, on index futures, 94% of the positions on the short side. Highest we've ever seen. So you need some kind of glimmer of good news, some kind of hope. And then, in fact, they'll be forced to cover out. So sometimes they being at extreme ends hasn't been such a bad thing. And the RBI bonanza that came in, right? I mean, out of nowhere, the governor, pro-growth, everyone is wondering about the Fed pivoting. Well, the RBI governor's, taken a trajectory of his own. Every time he's spoken, it's always pro-growth, pro-growth, pro-growth. And hopefully that holds us in good stead because we have the festive season that's coming up. You have earnings that hopefully will pick up in the second half of the year. And added to that, the US shutdown, out there, that could have increased the probability of getting some Fed rate cuts as well. So all in all, it was a decent end to a week that started off actually with the bulls being totally on the back foot. Anish, how do you play this? We have seen the GST 2.0, the various measures that have been announced as well. You have the auto stocks that have done well. What's your view on that? On the consumption theme, how do you play it?
See, the way I see it, the only issue with the economy is weak demand, right? All the structural things are fine. Balance sheets, bank balance sheets are fine. Corporate balance sheets are fine. Supply side, there's no issue. And when you have only demand as the weakness, it's a relatively easy problem to solve. Right? You've had monetary policy support, and more could come. So I do expect the economy should regain momentum. It might take a quarter, it might take 2 quarters, but the economy should regain momentum. And in an environment where you expect the economy to regain momentum, I would position myself towards cyclical sectors, right, which recover, which see the greatest impact when the economic rebound happens. So those would be industrial and capital goods, banks, it would be auto companies, cement. Now, of those, cement and auto have already had some bit of the run.
Yeah.
So from here, I mean, I would be most positive on the industrial and capital goods sector and banks.
You're right. But some, just to, since you talk about industrials and capital goods, just to come in, some were pivoting a little bit away from that because they said that the last few years the government has been pro-capex, pro-capital expenditure, and suddenly both in the budget as well as GST 2.0, it seems like the focus is only on consumption. But would you still believe, because some of these stocks have corrected a good deal, and actually in the last few trading sessions, they've been finding their feet. And I was looking at a couple of smaller companies as well from the broader markets. Some of those promoters went ahead and they bought a few thousand, a few lakh shares as well. Yeah, you're making that point.
So, I think it's a bit of a misinterpretation to say the budget is pro-consumption. Actually, the budget is pro-spending.
Okay.
Right? Spending could be investment spending from households or consumption spending. Investment spending is like if you've got more money in your pocket because you're paying less in taxes, you could bring forward your purchase of a house. Right? You could buy a larger house because now you have a larger budget. So I think it's a misunderstanding to say that more money in the hands of households necessarily leads to more consumption spending.
It could be, yeah.
It could be investment spending.
Indeed.
And then once consumption starts, obviously you need the capacity to service that consumption. So investment always picks up. So in fact, I've always been saying that, look, there's no point pushing for investment stimulus if there is already spare capacity in the economy, right? So first you need the spare capacity to get exhausted. Once demand picks up, then investment will also pick up. It's not going to be one or the other. I mean, ultimately, if consumption picks up, you need the capacities to service that.
Right. Okay.
You said balance sheets are in good form, but corporate balance sheets are in good form, government balance sheet is in good form. What about personal balance sheets?
So yes, there is some over-leveraging in the households, particularly in the unsecured space. And we are seeing that stress, right? We have seen MFIs have the issues. I do think that people are a bit over-optimistic on how quickly unsecured consumer stress will resolve. But it's not at a level to hold back the overall economy, right? It is an issue, but it's not at the level where I would say that it will hold back overall economy.
That mass segment, mass consumption, that still remains subdued? Or you think all these measures can turn that around?
I wouldn't expect that to be a big driver of growth, right? I think it'll hold relatively steady.
So at similar kind of levels?
Yeah. See, the problem actually, it's very difficult to gauge what's happening in mass consumption. A lot of the commentary is based around FMCG. Right? People say, look, FMCG demand is weak. But the companies that we are looking at in FMCG are, I think, suffering from a competitive issue problem, right? Their margins are too high, they're over-earning, and therefore they are losing share to less visible players, right? To local players, to regional players. And I wouldn't interpret that necessarily to say there is a weakness in consumption.
But the big highlight, the big bazooka came in from the RBI.
Yeah, and it was not rate cuts, right? It was those some 22 measures apparently. I'm not going to go into 22, but let me just highlight 10, which I think are important. And we'll sort of put some of these questions and ask Anish to put on his financials analyst hat and tell us which of these measures gives the maximum bang for the buck, right? So shift to EC, expected credit loss provisioning. There's a 4-year glide path to this now to smoothen the one-time impact of additional provisioning. Remember, basically they're moving away from incurred loss model to a projected or expected credit loss model. But the news is the 4-year glide path to do this. Removal of proposed restriction on overlapping businesses. Basically, banks doing what they could not do on the bank side, in subsidiaries, NBFCs, etc. There was always this overhang that because the rules don't allow for it, they'll have to do, some of these companies will have to sell these subsidiaries. But so that overhang kind of goes away. Introduction of risk-based premium for deposit insurance. It's basically, 12 paisa per 100 rupees. Now it is, it's a flat rate, but now it's moving away from flat rate. So it doesn't look like much, but it is expected to give a bump to, underlying profitability for banks. Banks can finance M&A. So far, banks could essentially fund acquisition of underlying assets, but not equity shares. Now they're allowed to do it. So we'll see how much of this, I mean, does the capability exist for banks internally in terms of people and systems, etc., to be able to price some of this? And will we see a big wave of M&A because of this? We'll see. But in any case, I mean, it's good because companies were going for private credit, dollar-denominated debt, higher cost. So all of that is easier now. NBFC risk weights lowered for infrastructure, so PFC, REC. So basically for operational projects, lower risk weights. Withdrawal of the 2016 large borrower guideline. So basically there was a 2016 circular which discouraged lending to borrower entities having aggregate sanction limit of over 10,000 crores. This basically has been repealed. There is also loan against shares, which has been for banks, which has been enhanced to 1 crore. So it's a 5x jump. For NBFCs, it is still larger. This is for banks. Now, easing restrictions on transaction accounts, so current account, OD, etc. So this again is important because most of the current account is with banks like HDFC Bank and private players who are good in transaction banking. And the rule said that if you have less than 10%, to be able to have the current account with you, you've got to have more than 10% exposure to a given entity, borrower entity. So this was creating some amount of anxiety that's been now eased. Discussion paper for granting new urban cooperative bank licenses. And of course, just simplification, 250 master directions to replace lots of scattered circulars. So it was a monetary policy, but not very much in terms of monetary policy itself. A lot of easing essentially aimed at unshackling banks, if I can put it that way. Which of these measures? You think that M&A bit or what struck you, Anish?
So look, overall, if you take them in aggregate, right, they do free up the banks to undertake more activities. Yeah. And those activities were otherwise being undertaken exclusively by NBFCs or by less regulated entities. So in that sense, it kind of reduces or it expands the boundary in which banks can operate, right? So it's good for banks relative to NBFCs. Now, so the way I see it, right, the banks have the advantage that they can raise deposits. NBFCs don't. And where the NBFCs traditionally had the advantage was that they were exempt from some of the statutory burdens, like their CRR, SLR, and priority sector is lower, right? So the NBFCs had the advantage that they don't have these statutory costs. Now, if a bank can also open an NBFC, so they will, to the extent that they can raise deposits, they will do the activities within the bank. Once you exhaust your deposit raising capacity, you can, through an NBFC, operate and compete with other NBFCs. So it does place NBFCs at an advantage relative to the banks. Banks at an advantage to them.
The private credit market was, you think all that gets squeezed now? I mean, why do you...
I mean, it doesn't happen immediately, but yes, banks will obviously develop the capabilities and then also step into some of those segments.
Because there was,
those were restricted, yeah.
Those were restricted, right?
Yeah.
But that space was booming, so maybe...
so the banks will obviously venture into that space because it is a profitable space.
One of the big calls for you, Anish, has been that housing is central, right, to your entire thesis. That
yes.
That is essentially what needs to do well for the economy to do well.
Yeah.
Are we, what's happening there overall? I mean, it's a very sort of city-specific, state-specific subject. It's not, it's not the same all over. But yeah. Is the music slowing? Is it still high tempo?
So it has slowed, right? And in fact, so I've always said that I can't imagine the economy not doing well if housing sector is doing well. And similarly, I can't imagine the other way around also, right? So housing is fundamental to economic growth. And you can see that, right, after 2020, once stamp duties were cut, the revival came when economic activity. And in the last 6 months or so, what we have seen is that the pace of growth has slowed, certainly. And there is, in fact, new housing sales might have dipped a little bit. Now, hopefully, what should happen is that developers should realize that, look, you're not being able to sell at these prices, so you give some incentives, etc., and that should lead to the momentum coming back. And that, frankly, if we are sitting here 18 months later or 12 months later, and if we say, hey, the economy hasn't done as well as we thought it would, the most likely reason would be that housing didn't pick up. So I do think, yes, there has been some slowdown, but I'm not, I would be optimistic that
It picks up.
It picks up again.
And any Bombay, NCR, I mean, these are two big value-wise big markets, right?
But actually, from an economic activity perspective, it's the square footage that matters, not the value, right? Because you need economic activity is driven by, how much cement do you consume, how much steel do you consume, how many workers are employed in building that house, right? It's not.
Any thoughts specifically on this market and NCR? Or
no, look, across. I mean, there is the pace of increase has definitely slowed, right? Now we need to see how the developers respond and.
In terms of incentives,
incentives and pricing and all of that to see that revive.
Anish, just stay on. We need to slip into a very short break, but we'll come back and talk about the IT sector. TCS reports numbers next week on 9th of October. Stay tuned. Welcome back. You're watching Editors Roundtable. This week, we saw the Nifty gain about 1%. The mid-cap index gained close to about 2%. Banks, metals did exceedingly well. But looking ahead to next week, well, there are two big cues. One is the IPO market is red hot. Nearly 30,000 crore worth of paper is hitting the markets next week. Tata Cap will be the big one, 15,000 crore. LG Electronics, about 12,000. And then the WeWork offer for sale of about 3,000 crore. So we'll test the market's appetite for liquidity and interest. But secondly, even the earnings season kicks off, and it starts as always with TCS on 9th. But the following week is when we're going to get bulk of the big earnings. So whether it's Infosys, Wipro, HCL Tech, all of them will fall in the 13th to 18th week. So what do you expect now? For starters, Q2 is likely to be a fairly stable quarter. There is no improvement in demand, but there hasn't been a deterioration in demand. In terms of revenue growth, Infy is likely to lead 1.8%. You've got about a 1.5% revenue growth expected from HCL Tech, Tech Mahindra. TCS could be a bit tepid, just about 0.3%. The rupee depreciation of nearly 2.5% has turned out to be a tailwind for margins, and that could absorb some of the AI-led deflation, any pricing pressure. So margins, at least, cursory, there should be some expansion in margins when we looked at Infy and TCS in Q2. Infy by about 50 basis points, TCS by about 20 basis points sequentially. And also wage hikes have been largely on hold so far at least. So what will you watch? In terms of guidance, for Infosys, only if the upper end is changed will it be material. Now, when Infy came out with their guidance, they were very conservative at 1 to 3%. Actual estimates were always between 2, 2.5, going up to 3%. Now they've also done one acquisition which is not priced in, but the street is saying that maybe they'll tighten, they'll bring the lower end of the guidance up, but only if the upper end, that's 3%, is tweaked and raised, will it be material, but that's not expected. HCL Tech is likely to keep the margin revenue guidance unchanged at 3 to 5%. What will you watch? Again, AI-related deflation, because the Cognizant, management, when one of the analysts met them in a non-deal roadshow, they indicated that the AI-led deflation in renewals is actually quite high. So any sort of pricing pressure, the H1B, there is going to be an impact on the cost of on-site. That's going to be tracked very closely. But broadly, the Nifty IT has been such an underperformer, 25% underperformance year to date, with the Nifty IT index down 21%. Anish, is tech a part of your portfolio or not at all?
So in the portfolio that we take sector calls, which is our business cycle fund, if you see, we've been, and this is the published portfolio, we've been zero tech for a while.
Zero tech.
And my logic was that there was a lot of optimism built around demand recovering in the US. And when I look at the US economy, it's actually doing very well. So I could not buy why the Fed should do aggressive rate cuts, because the economy is already in good shape. And frankly, I think the economy is more likely to weaken than strengthen from here. Right? So I think the sector will continue to face headwinds for growth. Also, I think, when we talk about the Indian IT sector, we must remember that it's not just the Indian listed IT companies. GCCs are also part of the Indian IT sector. And it's the GCC sector that's been gaining at the expense of the Indian IT vendors. So the sector overall is not doing that badly, actually. Yeah. It's the shift from Indian vendors to GCC.
We picked this interesting data point from the Naukri Job Speak Index. We spoke with the person, Pavan, leading it, and he said the hiring for GCCs in this September quarter was only 4%. The prior quarter was also 4%. And even the Jan-Feb-March quarter was only 2%. So it's not that the GCC hiring, although it's doing very well, it's maybe AI,
No, the reason I think, this is number of people, right?
The number of people, like the Job Speak Index, what they track is
so basically in GCCs, the larger guys are all already here.
Yeah.
Now, there are 2 opening every week, right? But the guys who are coming, they are smaller. The size is much smaller. You know, the Deloittes of the world, JP Morgan of the world, they're all here. They've been
And
here
they're
for
not
years.
hiring anymore now. So he said at least the existing big guys are not.
So in terms of the number of seats, if you look at, I mean, those are now smaller, specialized, high value.
High value.
But in terms of numbers, actual specific numbers, another thing, Rima, we speak about this. By the way, that they talk about IT, right? Infi.
Yeah.
Yesterday, OpenAI finally concluded that secondary share sale, valuing the company at $500 billion. Did Infi, we talk about that investment that Infi, did it actually happen or they thought about it? And
they thought about it. I think Sika went with a board approval as, sort of like a...
I remember the figure quoted at that point was $1 billion. I mean, that's what articles, etc. say.
Yeah, but I don't think it went through. But I think he went with a proposal is what, reports. But, Anish, in your blue chip fund, 75,000 crore, you're sitting on 8% cash. You're fairly optimistic about the economy recovering. So when will you deploy this 8% cash? In what? So tell us a little bit about that.
So, see, the way I see it, right, if I'm measured relative to a benchmark. So if I feel, look, there are parts of the market that are overvalued and I'm better off relative to that part of the market holding cash, I'm always willing to hold cash. So I don't see cash as that much of a burden. But yes, I mean, if valuations correct more, I will.
But do you think in cement and autos, where you are bullish, valuations are okay? Because we were chatting with the Goldman cement analyst. He has only one buy call. He said cement will do well, etc. Pricing has been resilient, blah, blah, blah. But he said valuations are expensive and therefore he has only one buy call in the sector.
Yeah, so look, across the board, valuations are not cheap anywhere, right? The question is where can you get the greatest earnings inflection to support those valuations? So I would still say cement you could
So you will buy now at this juncture?
Oh, I can't tell you what I will do at this juncture. That wouldn't be fair. But my published portfolio is still...
What about the view on metals?
Metals, I'm light, right? And the real reason is, if you look at most metals, demand is declining because China is 50% of demand, right? Ferrous metal demand in China is declining. And if you have Chinese demand declining, no matter whatever gymnastics you do on the rest of the demand, you still get...
But anti-involution, that's not good enough.
See, when an industry has excess capacity and taking out capacity doesn't improve the economics beyond a point, right? It allows the industry to survive. It doesn't improve the economics beyond a point. So actually the bigger argument is, yes, Chinese government will take out capacity and then the Indian government will give bigger safeguard duties. Frankly, how optimistic should one be on an industry where if you need 2 governments to support your buy case, right? So I'm kind of light on
the sidelines.
I have to congratulate you and Naren. I think, the duo were the first to really start talking about this 2.5 years ago, thumping the table on multi-asset funds, if you remember, right? And it's worked out beautifully.
Yeah, I mean, partly...
It's played out wide. I mean, they proved the reason for existence of those funds. Huh?
No, we've always been big on asset allocation products, on hybrid products. And I do think it works for the investor because the thing is those funds deploy in assets that are out of favor. Right? And it's generally works in the investor's favor.
You think that still is the way to go, broadly?
Oh, I mean, multi-asset funds and asset allocation products would be evergreen products. I don't think there's ever a time where you say, look, you shouldn't do multi-asset funds or asset allocation.
Okay, great chatting with you, Anish. Thank you very much for coming to our studio. Enjoy your weekend. Well, that brings us to a close in this edition of Editors Roundtable. Goodbye, and we'll be back Monday morning.